we're looking at a hostile economic and political environment that is going to cause investors to rediscover the value of having some of their wealth in gold and silver. And the investment demand curve will shift upward on a permanent basis for decades. Good morning, it's Jeffrey Christian of CPM Group. It's 11:45 in the morning on Tuesday, the 8th of October here in New York. I want to talk about the uncertainties facing the gold market and the silver market and what they may mean for the gold and silver markets going forward. Before I do that, I'll just look at the charts. I didn't bother to update them since October 1st because, quite frankly, the markets really haven't done too much. Gold has backed off a little bit, but it's basically trading around $2,660, having made a push to $2,700, and our expectation is the price will go higher. And silver got above $33 very briefly, and it's back down around $31.25 as I speak. But I want to take a talk about the longer term economic view and uncertainties. Some people say that gold prices only respond to the dollar, and if you understand the dollar and you have a strong view about the dollar's outlook, therefore you'll know what to think about gold. We had a client years ago, a billionaire, who was very sure of himself. He's lost hundreds of millions of dollars in gold. I think he's probably made it back now by virtue of the market recovering. But he lost that money by virtue of the fact that, as far as he was concerned, and he told me, all you needed to know was that the dollar was going to collapse, and therefore gold prices would rise. This was in 2008, 2009, and he was wrong for a long, long time before the gold price saved his ego. Other people will tell you gold only responds to inflation, and inflation's rising, gold prices rise. That's wrong too. Other people will tell you that it's this, that, or the other thing. They're all right and they're all wrong. The reality is that gold responds to inflation, to currency market unrest, to strength or weakness in the dollar, to economic activity in general, to political uncertainties, to national, international, and regional problems, financial market concerns. There's a gigantic panoply, as the term I used this morning, of issues that are very important in determining whether or not investors want to buy more gold or less gold, and whether the prices rise or don't rise or decline as a result of that. I gave a very interesting podcast interview to the Northern Miner yesterday, October 7th, and the interview started off with Adrian Pocobelli asking me, CPM Group always says it's uncertainty, and uncertainty of a wide variety of issues that drives investment demand and therefore the price of gold. And he asked, is uncertainty fully priced in the gold market now, today? And my answer was, well, we should think in terms of uncertainties in the plural as opposed to singular. And the uncertainties that we have been facing over the last several months and are currently facing are fully priced into the gold price today at $2,660 or wherever it is. However, we have a variety of uncertainties that are coming up. Over the next 4 weeks, the world, the gold market, the silver market, financial markets in general, will find a range of new uncertainties. International political ones, regional wars, Ukraine, Middle East, national political issues, economic trends, financial market stability. There's going to be a whole range of new uncertainties over the next 4 weeks that could be more virulent than the ones that we've been dealing with over the last few months. And over the next 6 months, we expect that to happen too. And it's this combination of uncertainties that will, we think, push gold prices and silver prices to high levels over the next 6 months, and possibly to new record levels for silver as well as for gold. It's that uncertainty that really matters. Now, you have to understand, uncertainties cut both ways. They are good ones and bad ones. And we have different scenarios that we draw that say, this is our most likely economic, political, financial, gold, silver scenario for the next 2 months, 2 years, 10 years. And then we have alternate scenarios that we're running. And we run a lot of them, where we tend to supply our paying clients with 3 of them. A main scenario, most likely scenario in our view, higher probability of occurring, and then a high scenario, high price scenario, and a low price scenario. And what would have to happen for that high price scenario or that low price scenario to shake out? And one has to be aware that things sometimes get better. I'm using this chart today because this is investment demand, and the black bars are years in which investors, with the one exception that's graphic error, years in which investors bought more than 20 million ounces of gold. And that tends to be sort of a threshold. It's not carved in stone, but you tend to see gold prices rising in those years as investors are concerned about economic and political factors. And the lighter blue bars are years in which investors bought less than 20 million ounces, and you can see that tend to coincide with flat to lower gold prices. There are only 3 years that have red bars. There are only 3 years since 1966 when investors, by our estimate, were net sellers of gold on a global basis. Usually, investors somewhere are facing real problems and they're buying, so that even when investors elsewhere are feeling more comfortable about the world, the late 90s, for example, you'll still see some investors having issues somewhere. In the late 90s, we were in a new economic paradigm where inflation and recession were killed and the Dow Jones was going to be at $40,000 within a couple of weeks. But you had the Asian financial currency crisis in 1997, 1998. You had a debt default by the Russian government in, I believe, 1998. You had very high inflation in Istanbul and Turkey for a while, and other countries in Argentina. So there were always places where the uncertainties were high enough to stimulate investment demand and keep investment demand positive. But for many years, for decades, you'd see 1 or 2 years of global economic and political uncertainties driving investors to buy more than 20 million ounces of gold and driving the gold price up. The first one was in 1967, 1968. The first one on this chart was 1967, 68. Vietnam, a variety of other issues going on. And after a year and a half, things were better and investors bought less gold. And that was coincidental with the U.S. Treasury closing the public sector gold window, no longer allowing anything other than central banks and monetary authorities to bring dollars to the U.S. Treasury and say, hey, you say that the dollar is worth $35 an ounce. Here are my dollars. Give me your gold. That window was closed in, I believe, April of 1968 after the Tet Offensive and about the time that LBJ said that he would not run for president because of the Tet Offensive and the fact that the Pentagon had lied to the government about what was going on in Vietnam, among other things. The next one was 73-74, Six-Day War. That was in 68. The 73-74 was the Yom Kippur War, quadrupling of oil prices, oil embargo, deep recession, high inflation. After a couple years, things got better. Investors bought less gold. The gold price subsided. 79-80, that changed again. 86, 87, and then 1993, and then again 1996. And it used to be that one or two bad years and then things would get better. But in November 2000, CPM Group issued its gold yearbook, that we called them the gold surveys back then. And we gave a speech, I believe the second Tuesday of November 2000. We said there's going to be a golden renaissance, and investors around the world will be buying more gold for a longer period of time as they rediscover the value of having gold in their portfolios. And central banks will join them later. And the way we phrased it was this. From 1980 until 2000, people would ask us, gold prices hit $850 briefly in January of 1980. Will we ever see $850 gold again? And our answer for 20 years was, look at the state of the world in January of 1980. You had U.S. hostages in Iran, Soviet troops in Afghanistan, 14% inflation, 21% interest rates. We were going into what was then the deepest post-war recession. You had economic and political and financial market instability all over the place. And in that environment, gold prices rose to $850 an ounce. And for 20 years, we would say, the economic environment has not been that hostile. If you can convince us that the most likely scenario is that you will see that hostile of an economic and political environment, we will grant you $850 an ounce gold. This was a period of time when gold basically traded between $320 and $360 for most of the time. A couple spikes up to $500, and then a long period from 1997 into 2002 when it was below 320. It was actually below 300 for much of those 5 years. But in November of 2000, we said, looking forward, our economic and political projections are that we will see a more hostile economic and political environment in the future than we saw in 1979, 1980, when investor demand drove the price to $850 an ounce. And we're not looking at 1 or 2 years. We are looking at several decades of hostile economic and political conditions, much worse than what we saw in the 1970s, at the end of the 1970s, and of course, over the course of the 1970s. We're looking at a hostile economic and political environment that is going to cause investors to rediscover the value of having some of their wealth in gold and silver. And the investment demand curve will shift upward on a permanent basis for decades, or semi-permanent basis if you want to be more accurate from an economic terminology perspective. We said in November 2000, we would see more investors and more types of investors in more parts of the world buying more gold than ever before in history at higher prices because of a hostile economic environment. And it would ebb and flow, but it would be very persistent. And you can see the black lines here, starting in 2002, 30 some odd million ounces, then going up over 40 million ounces in 2003. That's when the United States attacked Iraq. And the oil price started rising from $10 and $15 to $140 a barrel. We had problem after problem leading up to the global the global financial crisis and the Great Recession, 2008, 2009. Then we had an international debt crisis and a downgrading in the U.S. Treasury in 2011. That's that big spike there. And then things got better for a couple of years, 2013, 2014. And then they got worse, and then they got better for a couple of years, and then they got worse. And that trend is going to continue. And it's driven by uncertainties. What's going to be in the world? And looking forward, we still expect a more hostile economic and political environment than we had seen prior to 2000. That said, those two periods that I just pointed out, 2013, 14, 2017, 18, 19, those light blue bars here have to be paid attention to because uncertainties cut both ways. We have a main scenario, and that main scenario has gold prices and silver prices rising to record levels over the next 6 months, over the next 12, 24 months. And that is predicated on hostile economic and political developments. And I won't enumerate them all. Yeah. But we have more than 24 on our list. It is possible that we could see good things happening. First off, we are seeing good things happening. The economy in the United States, regardless of what you want to believe and regardless what you feel like when you're buying groceries, the economy is actually in much better shape than some people would have you believe. We have relatively strong employment. We have relatively strong economic output. Incomes in general and on average are rising more than inflation has been rising. Inflation has come down from 9% in 2021 to around 3.5% now. You are seeing a prolongation of the economic expansion. People have been waiting for a recession since 2022, and it hasn't arrived yet. It may arrive in the next 6 months, or it may not. That's one of the uncertainties driving the market. But the reality is that over the last 2 or 3 years, the economy has done much better than people think. There are things that we did. We outlined for our clients into market environments, in 2 market alerts late last year. We outlined the way that the U.S. government relatively painlessly could shift from a $1.3 trillion deficit this year, fiscal budget, to a surplus budget within a few years. The political will's not there for it to happen. There's too many lobbyists controlling too many politicians to let it happen, but it could happen. It's not in our main scenario, it's in our lower price scenario. You also could see a abrupt and positive end to the Russian invasion of Ukraine if the Ukrainian government and military are allowed to use longer distance weapons to bring the war even more home to Russia than it is right now. And that could end that relatively quickly. There could be regime changes in various countries that could be positive. There are a lot of things that could happen that could be positive, that could take the gold and silver prices down, not in the next 6 months, maybe not even in the next 12 months or 24 months, but somewhere beyond 2026. So I think that those uncertainties cut both ways, and they're here to stay. It's been 24 years since we made that speech in November of 2000. And so far, that's the way the gold market has worked and the silver market has worked. We have seen an increase in economic and political uncertainties and issues, and we're likely to continue to see that. There is scope for improvement. But right now, CPM Group's most probable way forward is that those improvements are very halting, if at all. And in the meantime, you have the scope for much worse situations, especially over the next 6 months. We'll see where we are when it gets to be next March or April. That's what I have right now. Let me just check my notes. I think that's pretty much what I was going to talk about. Take care of yourself. Take care of those around you. You can go to our website. You can buy our yearbooks. You can buy other research. You can send us an email at info@cpmgroup.com. and say, CPM Group, I'd like to know how CPM Group can help me manage better my exposure to precious metals and commodities. Thank you.